Good afternoon, everybody. Welcome. My name is Grant Colby, and for those of you who haven't met me, I am the co-founder and CEO of NCP Digital Family Office. And on behalf of the NCP team, it's my pleasure to welcome you today to this information session. And we put this on because we know that among the many stresses that people are dealing with these days are questions about the general health and wellness of their financial lives. But more specifically, what the heck is going on with this apparent divergence between the financial markets and the real economy? And so we don't aspire to be liars, so we readily admit that we don't know what happens next in terms of the market's behavior. But we thought it would be helpful and instructive if we shared with you some of the thinking that we share with the families that we serve, and they generally find these to be comforting in some respects. So this is really the first of what we hope are many presentations, and we hope you enjoy it. Now, the presentation that we have ready for you today is broken into two main sections. First is a fact-based assessment of the real economic and financial market data, including a look at some of the possible scenarios and outcomes that we think are possible. And the second section, equally as important, if not more important, we're going to share some practical ideas with you to consider both short-term and longer-term ideas with respect to how you can implement some risk management practices that we think are similar to what we do and what we find helpful. So our speaker today is NCP's Chief Investment Officer, Christian Gagnon, and Chris is based in our Montreal/Bromont office. And prior to becoming co-founder of NCP and the leader of our investment strategy, Chris co-founded and was the lead portfolio manager for AFC Capital, a long-short hedge fund, and we're thrilled that he's going to take some time to share his thinking with you. Chris also regularly posts his thinking and shares his ideas on LinkedIn. So if you'd like to follow him there and keep in touch with him, as well as any of the other team members at NCP, I know he'd be happy to accept a connection request, as would any of us. So please do feel free to reach out and touch base and follow him. So just before we get started, I'll get out of the way quickly here, but just a couple of housekeeping items. One is that to keep the background noise down, with the possible exception of Chris's dog Dookie, who appears to want in on this presentation. This is a live event, but it's in a listen-only mode. So there is a Q&A panel on the right-hand side of your viewer. So if you do have some thoughts and some questions, please do post them. And our moderator, Sam, will make sure that those get queued up and addressed by Chris. Also, your live event console is like a PVR. So if you need a break, if something comes up, you got to answer the door, what have you, or your own dog starts going crazy, you're able to pause, resume, and replay just like a PVR. And the event will also be available for replay. When we're done, please, we welcome your feedback, constructive or otherwise, and also any ideas you might have for other subjects that you'd like to see us cover in the future, because as I mentioned at the outset, this is just the first of what is hopefully many events. So thank you again for attending. And without further ado, I hand you over to Chris.
Okay, good afternoon, everyone. Hope you can hear me fine. Basically what we wanted to discuss with you is what we get, a lot of questions we get from the families we advise or people around us, basically answering the question, am I okay? So am I okay in my portfolio, in my wealth, facing everything we are dealing with since the COVID started? So we put a few slides, and as Grant said, there's a couple of parts. The first part is fact-based, and the second part is really, once we've gone through the facts, what we suggest you do or what we do, and then we'll open up for Q&A. So basically, everybody is somewhat worried about their investments today because we hear a lot of negative economic news. We hear a lot of of bad statistics. And at the same time, there's the stock market keeps kind of going up every day. So it's a big disconnect that people are worried about, and it worries us too. So we want to talk about that gap between the stock markets and the economy. Because in the end, what people are asking themselves is my portfolio safe facing all that? Are we out of the woods yet? Or what happens next? And these are all fair questions. As Grant said, we don't know the answers anybody better than anybody else, but the way we approach it is probably different from what a lot of people are telling you or what you see out there. Because in the end, what we find is that a lot of people are being told to do pretty much nothing with their investments, just to wait it out. And we wanted to know, is that the correct answer for you, right? So let's look at some facts. The first conclusion we want to make is this is not by any measure a normal recession. So we looked at a few statistics, and we wanted to compare it with what happens in an average recession and to what happens now. So the blue bars are really what we have now with the COVID-19 situation, and the orange bars are what you would get in an average recession. Just to know, there's been about 33 recessions since 1850, and the orange bars are the average of this data for all those recessions. So let's look at the first economic data we get is the GDP drop. There's a lot of different forecasts out there, but they range from -20 to -40 and some higher for the second quarter, so the quarter we are in now. So we take the stance that, okay, let's take the middle position, and if the GDP drops by 30%, and GDP, just for ones that don't necessarily know, is just probably the best measure of real economic activity. So if it drops by 30%, you see that's a very different drop than what you would expect in an average recession, where the GDP normally drops between 2 and 4%. When you get to 5, it comes to be a really large recession historically. Then we look at what are the unemployment numbers telling us. In an average recession, the unemployment would go from a normal level of about 5 to 6%, probably all the way to 7, maybe 8%. If you push to 9 and 10, it's quite rare. It did happen in the past. There's been very few cases that it did go above 10, but now the latest data we got from April and May are anywhere between 13 and 16, 17%. There's a lot of debate on the correct numbers, but let's say mid-teens, and then again, very different from an average recession. The other point we wanted to look at were the retail sales. 70% of the economic growth or economic activity is driven by the consumers that they spend for the different purchases they make, and most of that is the retail sales. So it's also a good indicator of the economic health out there. So in an average recession, you expect the retail sales to drop by 3, 4, 5%. Now the latest data we had for April was 15% negative. So again, very different from an average recession. But what's puzzling to everyone is the reaction on the markets, and what you get in those average recessions is a S&P 500 market drop by about 35%. Well, now the market did drop by about 30%, but it kind of went all the way back to what it was. So now it's barely negative from the peak just before the COVID started. but that was a very fast drop and an even faster recovery. Well, is that normal considering all that we've seen here? It's a good question, but one thing is certain is that this is not a normal recession. So then the other way to look at it is to us, this chart really represents what we call the gap. So the gap between real economic data and what the markets are telling us. And that blue line is just a ratio of the S&P 500 index to the GDP itself. So since 1947. And the blue line is the ratio, the black line is the trend line. And you expect that trend line to go up because of technology improvements, because of productivity gains, because of low interest rates, more leverage, companies getting better with their financial engineering. So there's a bunch of factors that make that this ratio is expected to go up, and it did. But you can see periods that the ratio is way above the curve, and some other periods it's below the curve. So what does that tell us? Well, if we look at history again as a teacher, we looked at in the late 1990s, early 2000, the market was really overvalued and was really disconnecting from that trend. So that really is a sign that we were in a bubble environment. Then again, the market dropped substantially, as we know, and it caught back to the trend level. What happened in 08 is we were a bit higher, but not that much, but the market really dropped below, and we were in an undervalued market. That represents probably good buying opportunities. Then the market went back up because we know that GDP is kind of always going up about 2% a year, except in recession periods. So what really drives this this blue bar is really the stock markets. So we got back to trend line about 2012, and since then we've been kind of slowly going up, and really recently we really shot up way above the trend line. And this is the red star here is the second quarter GDP expected with a 30% drop, and the market as it is today. So not only we are historically high on an absolute level, but on a relative level compared to the trend line, we are way above. So the argument that the stock market is cheap or is fairly valued in our minds is just not true, and just a very probably a very strong red signal. So that being said, we know there's a gap. What can happen? We looked at some possible outcomes based on historical facts. Again, we don't forecast where the market is going, but we think that history is probably the best guide we have. So we wanted to look at upside scenarios and downside scenarios. And in the end, what is the upside scenario from here? It's probably back to pre-COVID levels for the market. And that would imply a 5% swing up, maybe 15 if you say, well, we can maybe go a little bit past where we were in February. How long would that take to happen? Anybody's guess, but probably between 3 and 6 months. But for that to happen, the market would really show a level where before the COVID started, it's important to understand that there was no recession anywhere in the world. The unemployment was at historical lows everywhere in the world. We had record corporate profits from most of the companies. And we were already in an environment where there was ultra low world interest rates. At the same time, where we had very high risk appetite, meaning the valuations on the stock markets were already very high. So we had all those factors back in February. So if we were to get back there, or we're almost already there, it means that the market would tend to show this. So this could be an upside scenario. Let's look at some downside scenarios. The first one we want to point out is what happened in 2008, where the market dropped by 56%, so the broader S&P 500 index. And the level of a drop is something, but we also spend some time educating our clients on the time it takes to get back to where we were before those crises. And in 08, it took 6 years for the market to go back to where it was. So if you sold on the highest point and for 6 years, it was basically a zero return. So there's these, just to point that markets go down fast, but when they recover, it doesn't happen as fast. One point that's important to understand is in 2008, the consumers were not very affected. So it was mostly a financial recession. And when you look at consumer spending, retail sales, and all those figures, it wasn't down that much. Now, the other example for us that's very telling, and we probably feel that we're closer to this event now, is the tech bubble in 2000, where the NASDAQ index, which is really the index of the tech companies, was down 80% over a year and a half almost. And it took 15 years for the market to go back to where it was before the bubble burst. So that's a very long time. And as we know, it was mostly driven by the tech sector blowup. We also wanted to understand what happened in 1930s. We don't forecast that this is what's going to happen, but we're mindful that it's if something did happen in the past, it can happen again. And in that case, the broader index, so the S&P 500, was down 80% over about a year and a half. It took the market 24 years to get back to where it was before the crisis started in 1930. Those major events, which you call it a depression or a change of regime, don't happen too often. But from what we know and what we've studied, they happen every 50 to 75 years. Are we into one of those events? Well, time will tell, but we think it would be unprudent to really get that scenario off the table completely. And to conclude that those possible outcomes in history figures, then again, what is an average recession? It's about a 35% drop in the markets, and it takes about 3 years for the market to get back to where we were. You could argue that now the market was down for about a month, then it recovered for about a month. So it was really, really quick recovery. And if you look back in history, the sustainable recoveries don't happen over a month or two, they happen over years. So we know there's a gap. We know that it's puzzling everybody, but is it different? You know, can the gap be justified? And we do hear a lot of commentators saying it could be, or it is. So we wanted to look at some arguments and just put some facts on those arguments to see if it could be true or not. So probably the arguments we hear the most often is don't fight the Fed. Well, the Feds and the central banks of the world have been pumping trillions of dollars into the economy, and that did have an effect. But the fact on this is that the effectiveness of every dollar that they put in the economy has declined a lot since the last time they did a similar move, which was in 2008. So in 2008, every dollar that the Fed pumped into the system, 96% of it, so 96 cents out of a dollar, came back into the real economy. Today, the figures we have out of May and April is that it's only at 32%. So 32 cents on the dollar of every dollar that the Fed pumps into the economy goes back to have an effect. That's quite telling to us. And the conclusion is that, yeah, don't fight the Fed, but at some point the Fed does lose some ammunition or some power. Second argument we hear a lot is that the governments have it under control, and they're going to do everything they can to for that crisis to be not as deep as anybody would fear. So they've done a lot of stimulus, a lot of packages, as we have here in Canada, that to help the people. But at the same time, there's a limit to what they can do, because as we said before, 70% of the economy is driven by consumer spending. So if we think that the government will continue to print checks and send it directly to customers so they can spend, maybe that can go on a while, but it would be surprising that the governments do that forever. Meaning that if the people did lose their job or did lose their income or their spending power, they're going to cut back on spending. And this is probably just starting, because all the government, all the programs for the governments are going to run out in the next month or two, or maybe before summer ends. So the third argument is that we've learned from past mistakes. So the central banks of the world, the governments, the finance ministers have learned from past mistakes. And maybe that's true. Maybe they did learn from some mistakes, But we find it very interesting to look at the study. There's a book called 800 Years of Financial Crisis, written by two Harvard economists. And I encourage you to read it. It's very interesting. And they look at all the different financial crises that happened over the last 800 years in all the countries in the world. So they've done a tremendous research job. And in the end, the conclusion is that every time we enter a crisis like the one we're in now, we always think that this time is going to be different and that we've learned from the past. But when we look after the fact, it's, yeah, maybe not. So we said, yeah, there's a gap. Is it justified? Maybe it is, maybe it's not. Then again, we want to take a neutral stance, and we wanted to show some possible scenarios of what can happen to that gap. Basically, there's three things that can happen. Either the economy shoots up, so the market stays where it is or continues to go higher, and the economic data shoots up very fast to catch the market. Second scenario is that there's a severe correction, so the stock market goes back to meet where the economic data is. Or the third scenario is that that gap persists for a while. So we want to look at each of those and point again some needs to happen and some facts. So for scenario one, if we think that the economy shoots up, basically we need to have almost no permanent damage to the economy. We need the consumers to be back strongly spending, and we need the jobs to be back to previous levels. So we would need the unemployment levels to go back down very fast. At the same time as we would need corporate profits to be back to at least previous levels. So not only to be back to where they were, but to at least have some growth. And in the end, the facts today are that the markets before the COVID started were already fully valued in our analysis, and the profits were already declining pre-COVID, and we don't make that up. It's data you can find, and at the same time that a lot of those jobs that were lost have been made permanent. Just today, Starbucks announced that they were going to close 400 of their stores permanently. Well, maybe there's 10 to 20 people working in those stores. Well, that's another 4,000 to 8,000 jobs that will be lost permanently. And every day we get similar news like that the jobs that were lost, and all of it will be back in unemployment. And there was an interesting a poll done, I think, the beginning of this week or last week, of all the people that have lost their jobs in the U.S. They polled a couple thousand, and people were answering that 40 or 45% of those people did not expect to get their job back. So maybe it's too high, maybe it's too low, but it's definitely a significant number. Adding to that, the social unrest that we've had in the past few weeks, it's definitely another risk to the recovery. We wanted to put a bit of perspective, and we've talked about retail sales a bit earlier, and this is the retail sales since 1992. And you see that it's really something that normally is quite a straight line up. So it really follows the population growth and the level of creation of wealth. And you see that this drop here is what happened in 2008. And it's interesting to note that it did drop, but it took probably 4 years to go back to where it was before the drop. And this is where we are today. So that's end of April. So it doesn't include the May numbers. We're probably down again. So it's a much deeper drop than we had in 2008. And if everything to go back up, well, not only would we need to go back to where we were, but we would need to go back to a growth, which we always had in that curve. So it's an interesting fact to look at. Scenario 2 is a severe correction. So for that to happen, well, we've said you need a significant portion of those job losses to be made permanent, which is probably going to happen. We just don't know how much. You need the consumers to spend less and save more. As we said, consumers is 70% of the economy. And if they've been shocked, if they were afraid of losing their house, their income, there's a good chance they save more and spend less. And once that happens, it normally doesn't last a few months. It takes a few years to reverse back. This is what happened in the 1930s. The savings rates were almost doubled in that decade. You would also need a lot of debt defaults and some bankruptcies to rise for a severe correction. And yeah, we do see some bankruptcies starting to happen. The facts it's 28% of the US workforce did file for unemployment. That's a record number. It's a very high number. The corporate profits for 2020 compared to 2019 are expected to be down 25%. And that's a very fuzzy number because a lot of companies have stopped to give guidance because they just don't know where profits are going to go. So there's a chance that that goes in up or down there, definitely. So the total debt levels are today at historic high levels, and they're still rising. And at the same time as the GDP is down 30% in Q2, and it's probably going to be down around 10%, maybe 8 to 10% for the whole year 2020. This is a chart representing the debt level in the US and dates back to 1929. And you can clearly see that you started that period with fairly low debt levels, and it really popped until the end of World War II. And that was really the change in monetary regime in the US. And it really, it was the beginning of a big deleveraging period where debt levels were very high and went back down to probably 88-year lows in 1974. And since then, we've been going up quite substantially. And today we're at 122%, and that dates a few weeks back. So debts are still rising. So we're probably at 125 or 130 as we speak. So again, debt levels that are unseen. We also wanted to show you this chart that we did put out in one of our LinkedIn pieces, and it shows what the time of the markets to react to an event. So basically, this is the NASDAQ in 2000, and this is peak level here. And you had an initial drop in 2000 when it started to crack on the technology sector. But following that initial drop, you had a period where the market was basically up here it was substantially up, not back to previous level, but it was still 20% up, 25% up, and it stayed into a period of volatility or up and down for several months. And between you had that initial drop to the big drop, which really started here all the way down to 2001, that 45% drop. Well, there's a 10-month period between the two. So we look at the markets daily, we look at it weekly, and we think it's a long time. But in the end, those things normally take months, and because we just don't know what the risks are and what the real domino effects are going to happen. So as people discover those things, the market normally reacts probably a bit later than you would expect. Scenario 3 is that the gap persists. So for that to happen, well, we would need the FOMO to stay there. So the fear of missing out, people see the market going up and they say, well, I've missed the recovery. I want to put money today, and they keep pushing the market up, not necessarily for a fundamental reason, but mostly for follow the trend. So you would need that to persist. You would need investors to invest, I guess, in stocks pretty much regardless of valuations or fundamentals. So the valuations, they stay very high, and you would need the world governments to continue to print money and inject a lot of money through the economy. And in the end, the facts are that the Fed money printing is, as we said, is diminishing fast, and valuations are back to 2000 levels. And I've got a chart for you here. And in the end, the conclusion about gaps is that they never last. It's just a question of time. It's either that the economy goes up or the market goes down. But in the end, fundamentals always catch up. It's just a question of how long does it take to happen. That chart here just shows you just a basic valuation of enterprise value to EBITDA. So it's basically just a measure to see how the companies are valued. And this dates probably last week, and it shows that we're back to 2000 levels. So it's another example to show that the market definitely is very highly valued. So in conclusion, for those three scenarios, we think scenario 1, it may happen, or we think it's unlikely. And for scenario 2 and 3 to happen, then again, it's very difficult to forecast. But the one thing we know is that scenario 2 and 3 are higher risk scenarios. And if that is the case, well, it's definitely prudent to, and it's definitely good timing to know what the risks in your portfolio are. And that is really the topic of this presentation. If we agree that scenario 1 is unlikely and scenario 2 and 3 could happen, and if it does, it won't be anything fun, well, it's a good time to reassess risks for you. So the risks are there, they're real. What do we do? Now what? Well, what we do is basically look at what are the best practices on terms of risk. If you want to look at and manage your risk, well, first thing you got to have is unbiased advice. And we'll tell you a bit what this is for us on the next slide. And you also need to understand your own risk and then define it. How much, in terms of dollars, well, what does risk represent for you? And in the end, it's a good thing to manage it. Coming back to that unbiased advice, it may sound a bit salesy, but in the end, it's a very important factor for us. And first point to get a real unbiased advice is to acknowledge that no one knows what happens next. So there's a lot of market commentators that are calling for the market to go up, to go down. They just don't know more than anybody else. And just to acknowledge that it's definitely probably the basis to get unbiased advice. The second point is that the compensation you pay your advisors or the people that are giving you advice on your financial wealth, your compensation should not be linked to what you should do. If your advisor will reduce his own income if you decide to go a portion of your assets in cash and he's not paid on this cash, well, maybe you don't necessarily get the correct correct advice. Third point is to get the real facts, not the sentiment, not the emotion of the moment. And this is something we spend a lot of time here at NCP trying to put aside the emotion and look at the facts. Fourth point is to look at all scenarios, good or bad. It's not fun to look at bad scenarios, but they did happen in the past. And we think it's really unwise to dismiss them, going back to our argument that, yeah, this time it's going to be different. Well, what if it isn't? Then, okay, as we said, as Grant said at the beginning, how can we give you some advice on how to manage your own risk? And let's look at this pie chart, for example. And if this is your wealth, which is comprised of some risky assets and some safe assets, and the proportion could be different, but what we find is that most clients we have come up and they always have more risky assets than they thought or that they would like. So what are risky assets? Well, they're stocks, they're funds, they're ETFs, basically all investment vehicles that are linked to the daily movements in the markets. And what are safe assets? Well, they're fixed income securities, they're government short-term treasury bills, not necessarily something that will give you a lot of returns these days, but are generally quite safe. So the way we want to present it to you today is to measure, you could measure your risk if you define for yourself what is a maximum loss threshold. So let's call that an MLT. What's a maximum loss threshold? Well, it's basically the maximum amount of money you can tolerate to lose in a major bad event. So if there's a severe correction, if there's a depression, if there's a tech bubble crash, that's going to affect your wealth. Well, how much money are you willing to lose if that happens, or are you able to lose? And we've defined that that purple slice here, saying, for example, let's say this is my MLT. So out of my total wealth, I define this this slice X dollars, and this I don't want to go below that number. So this is my maximum loss threshold. Okay, now what happens if the equity markets drop by 50%? Let's take an example. So the yellow portion that you had before, well, half of that is lost tomorrow to a market movement, which is represented here by this red slice. Well, if it's bigger than your maximum loss threshold, well, it probably means you have a problem. So the way we represent that is that you probably have excess risk in your portfolio, which is represented by that black slice here. And in the end, the short-term solution for that event would be to reduce your excess risk. So stick to your maximum loss threshold and make sure you have enough safe assets to weather a storm that could happen. That's the short-term solution. Grant has alluded to a permanent solution. That's pretty much what we do for clients, or the way we look at it. And in the end, it's to implement an institutional grade decision support processes. So basically, we look at what are institutions, what are pension funds doing, how are they addressing risk, and how do they manage it? And we try to bring that to our clients. And we thought it was interesting to show you a bit how we do it. And in the end, it's do the right things right. The way we wanted to present it was to look at this this baseball diamond analogy. And in the end, your goal is really to round the bases and to score points if you want. So basically, for us, it's getting to home base, starting from home base, getting to first base, second base, third base, and getting back to home place and doing it all over again. So I'll explain a bit to you how we do it. So for us, the first base is, or the first step is what we call wealth data aggregation. So in the end, what this is really to aggregate all your wealth and to put it on a platform that will give you a live picture of your wealth across all asset classes, across all institutions, all banks. Everything is connected, and it really gives you it's a bit your foundation of everything else. And in the end, for us, we often say to our clients, well, it's really difficult to manage what you can't measure. So getting access to your data is the first thing you should do. It gives you a picture of the forest, not just the individual trees. And we find that most clients have more than one broker, they have more than one institution, and in the end, they're quite confused with their wealth. So aggregate all your wealth into one place and own your data. To us, then what we do with that is we do kind of a basic diagnostic of that wealth, and this is what we call a wealth health report. Basically shows you where are the risks in your or where are the basic risks in your own wealth. Once we've done that, we go to planning. Planning is very important because it shows what do you want. And this is something where pension funds and institutions have spent a lot of time because they do have obligations for their pensioners, and they have to deliver on those obligations. So once we have all the data, let's do planning. And the way we do it is what we call goals-based wealth planning. So we align your plan with your goals. So you might have more than one goal. You might have 3 goals, 4 goals, which could be to retire in a certain number of years, to leave money to the kids, buy a house, buy a cottage, go on a one-year trip around the world. Whatever that plan is, well, it necessitates a plan. If it's a goal, we're going to match a plan according to it. So picture that your wealth could be split in 2 or 3 different buckets, and each of those buckets would represent a goal. And this is probably the best line of defense in terms of risk, because if you have one of those goals that's very short term and you cannot tolerate a loss, well, it's going to end up in an investment policy or a plan that's really, really safe. As opposed as if you have a very long-term goal of a foundation or giving money in 30 years to your kids, well, that plan can probably take more risk because you want to generate more return since it's a longer-term plan. So in the end, we produce what we call risk-aligned plan and investment policy. But just like an institution would have, institutions have really detailed investment policies that they implement. It's the same thing for individual clients in our minds. So once we get the data, once we get that plan, how is the portfolio okay to make it happen? So it's to go into what we call advanced analytics. So third base for us is really risk and performance analytics. So we go quite deep in in a client's portfolio, analyzing what has been the performance, where are the risk factors, what are the different exposures to a commodity, to a currency, to a country, to a bias, and it really drives to get to know where the risk is. So get the data, one, make a plan. So basically state your objectives, and then can you attain your objectives from the data that you have? If we need to analyze that and to make it sure that everything's fine, so you can get to your objectives. It takes the deliverable for us as a wealth analytics report again, which is a detailed review of one's wealth. And this is something institutions do daily, of course. Once we get those three bases, well, it's time to put it to work. So it's time to implement all that disciplined executions, to have the right system, to have the right policies and procedures. And so basically, we've rounded the bases. We're back to home plate, but we just don't stop there. In the end, we go back to first base and second base and third base, because this is a process. It's not a report you get one time and that you put in a drawer. It's a process that's continuous, because life changes, goals change, markets change. We have a crisis like we have now, and that sometimes necessitate policy change. It can create a different investment policy, and that's very the essence of a good process, is to have that process exactly like it says here, to have it continuous. On that note, that ends it for me, and I'll take it. I'll be taking questions if you have any, and if you do not, well, I hope that was helpful for you.
Awesome. Thanks, Chris. We do have a couple questions on the side here. We'll start with Matt is asking, how would we think about bonds or even cash in our portfolios in the current environment to mitigate equity risk? Should we be worried about fiat currencies?
Well, yeah, probably would, definitely. But in the end, we don't know what we don't know. So our view is that we would stick to what's the safest thing out there. Defining a safe assets is always risky, because nothing is ever 100% safe. What is the safest assets? It's probably the US dollar and the US short-term bonds or US Treasury notes. The US is still the reserve currency of the world, and the US government is still the strongest government in the world. And that's probably where you get least risk. But definitely, we do advise our clients to put some money, some of their assets into gold, and to consider other assets. And this is going to be one of the topics of probably one of the next webinars, is to diversify away from markets, probably more into private equity, into good businesses operating and generating good cash flows, or even some real estate, not all real estate, but some real estate, which are really hard assets. So to answer the question, yes, there's a risk that fiat currencies turn up into something different. There's a couple of people saying that, but in the end, for now, we think it's probably prudent to stick to US dollar denominated short-term government bonds. Of course, there's no return there today. That's a problem, but for sure, you can probably tolerate no return instead of losing a lot of money. So again, what we're living through now is not an average recession, and we don't take the view that it's just an average recession and it happens every 8 years, and you just stick with your portfolio and do nothing. We think it's probably prudent to look at it and reassess what are the real risks, and at least know what the risks are, and can you tolerate them? If you cannot, well, there's definitely something to do with it.
Perfect. We have another question. Someone is asking, how hard is it to aggregate your data across different institutions?
It's a process, so can't say that it's easy, but we were doing it. We have done it with most banks, or almost, well, I'd say all institutions in Canada. It's been surprisingly Well, okay, it's just a question of time because there's, files to be filled and everything and connections to be made. The good thing is once it's made, it's there. So what we hear though is that not a lot of people, or almost nobody's doing it in Canada, because obviously it's difficult to do if you're a financial advisor from Royal Bank to aggregate data that would be at CIBC or BMO. They just don't do that, and the banks wouldn't allow that. So you need an independent provider to do that. But yeah, so the answer to that is it's really doable, and we're doing it, and we've done it for several people. It's just a question of a couple of weeks to a month to connect all that.
Awesome. Do we have any other questions before we say goodbye to Chris?
Okay, well, if there's no more questions, I hope you enjoyed. And as Grant said, if you have any questions, please connect on LinkedIn or send us an email. We'll definitely be happy to share our thoughts. And if there's any way we can help, we'll definitely make it a priority. On that note, I wish you all a very good end to your Wednesday.
Thanks, Chris.
Thank you very much. Thank you, everyone. Thanks, Sam. Bye-bye.